Good morning, traders, and welcome to this live intraday strategy webinar on SB Trade Desk. Today is Wednesday, March 21st, and it is Fed Day. Great to be with you guys this morning. We got Dagon in the house today. Great to see you. Chris, Mark, Pete, Peter, Pooja, Ruth, Tom. Great to see everyone in the room. So the FOMC interest rate decision is on tap today. 2 o'clock, we get the decision alongside the updated quarterly projections on inflation, growth, employment, and obviously the dot plot interest rate dot plot is everyone will be looking at. We'll get the presser with Jerome Powell, his first as Fed chair, at 2:30 shortly after. So, you might get a big spike in volatility depending on what the projections show. We'll go over a quick review of that again today. I know we looked at it yesterday, but a quick look at that today again. And then obviously the Q&A. It's going to be Jerome Powell's first Q&A as Fed chair. These events tend to set the tone, okay? I know you guys may have seen yesterday, last night, Jamie posted this chart. Really interesting stuff, okay? This is a chart for bonds since the 1981 trend line that we've been following. He's highlighted for you every time we've gotten a new Fed speaker. Obviously, Bernanke was the one who kicked off this new era of Fed press conferences post-decision. So, the first one that we got back here was about, 2010, 2011. That was the base where we first tagged that trend line again. Yellen's first press conference, interestingly enough. Here we are, Powell's first press conference. It's going to be interesting to see if we get a similar reaction. This is bond prices, right? So certainly if we get a rebound here, that would suggest yields should move lower. And we've been looking at yields over here on the TNX. This is the 10-year note. Really struggling at 290. We've been talking about 290 since the start of the year, guys. Basic trendline resistance or channel resistance dating back to the 1994 highs, multi-decade trendline, coming in line with current uptrend resistance. And that's the pitchfork that we've been following from the 2015 lows and 2016 lows. So things sort of look pretty in line, right, with a possible rebound in price for bonds, possible pullback in rates as long as we stay below this region. So some interesting stuff to look at. Obviously, we want to focus on what the trade setups are going to be. We're going to jump into that in a moment. But as always, I do want to encourage you guys, any questions, trade setups you'd like to review, feel free to throw them on the message board at any point. Hey, Dagon, great to see you, man. On the menu for today, we'll start off with a look at the DXY, where that stands. We'll take a look at Euro, Dollar CAD, beautiful play in Dollar CAD, finally turning over. Sterling dollar, Aussie dollar, still a little hesitant to touch Aussie dollar. We're kind of dilly-dallying at really critical levels. Same thing with Aussie yen, by the way. And then Euro Aussie actually pulled into a nice spot yesterday. A break lower from this near-term formation would shift the focus lower in Euro Aus. The broader focus is still higher, okay? So we'll take the implications of what that trade looks like at this point. Okay, and as I mentioned, anything that you didn't hear or that you do want to cover, feel free to throw them on the message board at any point, guys. Let's jump right in. Here's what we look like. So last night, obviously, we had a quick review of what we're looking for heading into the interest rate decision today. Don't forget, Eman, are you in the room? Yeah, the New Zealand interest rate decision comes after the market close here today as well. So if we have time, we'll take a look at what the Kiwis doing. We talked about our distaste for that yesterday, but we'll review if you have time. So the economic quarterly projections, okay, keep your eyes, I showed you this yesterday, but keep your eyes really focused on the core PCE, the core personal consumption expenditure, the Fed's preferred gauge of inflation. We've seen this start to move a little bit. It was at 1.8 a couple months ago. They bumped it up to 1.9. This is really the Fed's main problem right now. Remember, the Fed has a dual objective, okay, a dual mandate, fostering maximum employment and price stability, i.e. inflation. So with the employment picture continuing to suggest that the U.S. labor markets are at the natural quote unquote rate of unemployment, the focus really has been on the on wage inflation specifically, but overall inflation is something that they're trying to stoke. So if we see an uptick here in the median expectation for 2018, expect that the markets will start to price in 4 hikes. Remember, the biggest question the markets are asking is, are we going to get 3 hikes, as the dot plot essentially suggests, or are we going to get 4? The biggest concern is that if we start to see inflation running hot, or expectations for inflation running hot, that fourth interest rate hike will start to get priced into the market could offer a little bit of a lift for the greenback. All things held constant, our outlook for the dollar remains unchanged. Okay, so just keep your eyes focused on this. Obviously, GDP is going to be something that we're always watching. We got an uptick in that last year from 2.1 to 2.5, a big expectation for higher growth domestically, and also obviously unemployment rate 4.1 got revised to 3.9 for 2018 back at the last quarterly projection. So this is the column that you want to be focused on. As far as the interest rate dot plot, we went over this yesterday as well. It's basically the 2018 median estimate still between 2.25 is where most of the Fed members sit. So we're going to see the distribution here. If this changes at all, look for market reaction. Keep in mind, again, we always want to take note what the Fed sees the longer running projection for interest rates, or the terminal rate. The median there is basically 2.75 to 3% is where most of the Fed sits. And again, historically, by historic standards, that's still pretty low. So we're going to see if there's any shifts. This is the chart that everyone will be running with. I'll have a tweet out as soon as I can, giving you a side-by-side comparison of the two. But those are the two aspects really critical that we're going to be looking for in today's interest rate decision. Obviously, devil's in the details, okay? If we don't get, if we get a lackluster reaction to the actual projections, wait for that presser, okay? A lot of times these Fed chairmen, guys, on their first run, you remember Yellen, I remember it vividly, she slipped and said, for an extended period, maybe 3 to 6 months, or she even threw out a time frame, and the markets just absolutely obliterated her for it. So be attentive to the interest rate or to the commentary at the presser after the interest rate. Again, that's at 2:30, and we'll give you updates on SB Squawk if anything really critical presses the wires. Okay, so just a quick outline there, what we're looking for. I provided the link for you. If you click on this link, as soon as the release comes out at 2 o'clock, you'll find that PDF right here under recent documents, and you'll be able to view the new projections from Fed members. So keep that link handy at 2 p.m. Here's what we look like with the DXY. So, I don't want to go too much into this because I want to leave time this session for as many questions as I can, but we've talked about this analog ad nauseum. The 1994 decline still suggests below 91.33. The broader risk for the dollar index still remains lower. It's the low week close from last year. We have median line resistance there. We also have the initial yearly open reversal, basically, that we made right into the open of the year. Here's what DXY looks like on the weekly, okay? And that reversal close comes in just ahead of that at 91, essentially. So this is a big, big region of resistance. And on the broader scale, in the unlikely scenario, again, our bias, our basis is maybe one last stab higher in the dollar, but we should essentially be looking to fade that, okay? On a stab higher, as long as 91.33 holds as resistance, I do want to be fading dollar strength. Okay, so just putting that right on the table right now. So we could see some more strength, but 91.33 is our line in the sand. And obviously, based on the analog, even the analog capped out that advance before, slamming lower and posting a larger low before making a larger recovery in price. So keeping that in mind for the DXY, here's what it looks like on the daily chart, getting kind of messy. The only thing I wanted to highlight here is, this notion that a lot of retail traders will have, oh, they're hiking interest rates, the dollar should remain supported. Well, that's just not fact, okay? That whole notion is just not fact. And I just took a second to highlight, here's the last time that we got an interest rate hike. It was in December. Yellen's final interest rate hike that day saw the dollar come right off the highs and moved into this larger decline into the open of the year. So you could see that running into that interest rate decision, we were all expecting that hike. There was no surprise. Markets has priced in 25 basis point hike, and when we got the release, the dollar started to fall off, and that was the end of the start of that monthly rally. Okay, here we are again. Markets have been pushing higher for the last 2 weeks. We do know that they're going to hike rates. There's no surprise here, but the focus will be on the commentary and the suggestive rate dot plot that accompanies it. So, again, it could be the scenario where history repeats itself, and even if we were to get a spike higher, look to fade that rally. Initial resistance starts at 91. That's actually the low that we posted last year. The low day close at 91.33 is sort of our bearish invalidation level. So looking for the turn. Could this be it? Sure. The momentum trigger we've been following for the last 3 weeks is still in play. 1 touch, 2 touch, 3 touch confirms even got a fourth and fifth touch. Okay, so if we get a downside break on this trigger today on a close basis, it would suggest that we are heading lower in the index. Also note that the broader momentum profile for the DXY since the start of the year, basically since the December high, has been bearish. Here's momentum dipping below 40. Here's resistance ahead of 60. Here's a break below 30, oversold. Here's resistance ahead of 60. And again, yesterday on that last push higher, still turning ahead of 60. Okay, so it's suggestive that the momentum profile still remains rather heavy on price. Okay, and if we get a close below this, remember it has to be a daily close, it would further offer further evidence for our hypotheses of a broader dollar decline. Intraday, getting a little messy, but still working with these levels pretty well. Okay, so here's the DXY in the 120-minute 2-hour chart. We've been talking about this ascending channel formation that we've been following essentially since the monthly lows. Here's your March 7th and March 8th lows, continuing to hold support. Parallel off the highs here, sees perfect touches of resistance. That allows for an advance all the way up into possible spike into the March open, guys. That is 90.67. If we were to get that again, it would still be within the confines of this near-term uptrend. But certainly those are near-term levels of interest on today's spike. Okay, 90.51 would be an exact 100%, 2 equal legs off the low. And of course, a spike into that March open would be confluence resistance. So both near-term levels of resistance, if we would get a dollar rip-a-roo, again, 91 and 91.33 are going to be those key levels that we look for to maintain the broader bearish bias in the greenback. If we break above these levels, guys, we have to reassess. And we have to allot the possibility that the dollar is, in fact, basing. Not our favorite scenario, but we always have to have that if clause in there. Okay? So on its face value, guys, right now, it does, I'm not going to dismiss this as an opening range break. This was only a couple of pips higher. We only spent 3 hours there, 4 hours there before breaking lower. So I'm going to still allot this as the weekly opening range. We're basically trading at the weekly open right now. Okay? 90.21. And look for a break of this near-term range. Ideal scenario, market rips higher, spikes into the March open or even 90.51 and then turns around. So I'll be looking for an exhaustion trade, keeping all things constant if there's not that big of a change in the rate dot plot. If the projections continue to maintain this same, asserted growth path, then you would look for any type of strength to fizzle out at these topside targets near term. A break below the objective weekly opening range low, 89.77, in my mind, would be enough to validate the turn in price, and then we'd be right on back on target. These targets haven't changed since last week. So 89.59, I'd be looking for a soft target there because we already broke lower earlier, but really 89.28 and the low day close at 89. Okay. Any questions on DXY? Looking for long in CAD yen if you have time. Pooja, let me write that down. We missed it yesterday. I'll take a look today for sure. I don't follow that one, but we'll be more than happy to take a look. Okay. So DXY, hopefully we get some play here. I want to see this thing start to move. Now, we talked yesterday briefly about the wave count here, guys. I just want to add some color. We are starting to get a little bit more clarity on that. We talked about the fact that this looked like a 1, 2, 3, 4, 5 on the way down. It looks like a 1, 2, 3 on the way up. It looks like a 1, 2, 3, 4, 5. Again, remember 5-wave motive, 3-wave correction, 1, 2, 3. So if this is the proper wave count, we are still on that path. This is a 1, 2, 3, 4, which suggests that we need one more 5-wave to complete the pattern before we move on a larger corrective path. Could be the play, but it certainly would match in with sort of our broader expectations here. Okay. All right, let's move right along here. So that was number one, DXY. I got a clear picture of what that's doing. Euro, look, I don't, obviously Euro is going to be sort of the inverse of what we're looking at with the DXY. So here's what Euro looked like last night. So no change to any of the levels on the DXY chart, obviously. We've pulled back. We're basically trading just below this region, right back at the weekly open. Euro is very interesting. Look, this is the weekly chart we've been looking at with Euro. I've showed you this one a couple of times as well. At the end of the day, the weekly close is going to be critical. and we've talked about the fact that the upper median line parallel here has been a very decent pivot in price. This slope has been phenomenal ever since the two jump offs here. The 50 line, we got that median line break right there, same slope, parallel. The break there fueled acceleration, upper median line parallel resistance. We've been pivoting along this ever since. Now, remember, our bullish invalidation remains steady at 2167. As long as price stays above this, you're still broadly within the controlled advance that we've had since last year's low. So even if we were to spike lower, matching up with what we just talked in the DXY, if the DXY spikes higher, euro dollar spikes lower, that's the level you want to see hold, 2167. Absolutely critical. Not just because it's the 50% retracement of the entire decline from 2014, but guys, also it's just an objective basic trendline support. One touch, two touch, three touch confirms, converges right on that same region. Okay. Also note, look to the left there on my cursor. It is the low close for 2012 right here, 2161. Give me a 4 pip allowance. Okay. So broadly speaking, from a weekly standpoint, I do want to see this trend line hold. Intra week, there's nothing, it wouldn't be outside the realm possibility this thing spikes lower at 2167, then rebounds. At the end of the day, if price settles below 2167, finito. Okay, you've just broken a basic trendline support off the yearly lows from last year, and you'd expect a larger decline in the euro. Okay, so DXY 91.33, really 91 near term. Euro dollar 21.67. Those are our lines in the sand. We're looking for an exhaustion ahead of both of those regions. Daily chart for euro looks like this. Okay. Keep in mind that we are simply now kind of trading mid-range for the month. Here's your monthly open. We ripped into a new high in the first 7 days of trade. We've been sitting in that same range ever since the March open. Again, 2167 coincides with basic trendline slope and that 50% retracement. Also, why that region's so important now is because that is also the objective monthly opening range low. So we talk about opening ranges all the time here, guys. If the monthly opening range breaks the downside objectively, that gives us a downside bias heading into the end of the month. Not the favorite scenario, but that's what you're defending against at 2167. Resistance is pretty steady. 2409 is the 2018 high day close. We posted that right back here on February 16th. So that high day reversal, outside reversal close comes in at 2409. You've seen stiff resistance there on a daily close basis. Last couple weeks, it's been stiff resistance just on an intraday basis. That's the level we need to be to really suggest that the upside resumption trade is on hand. You'd be looking for that stretch near 25.98, basically 126. Okay, so monthly opening range remains intact. 2167 is the level to know for euro. 2409 pop gives us the conviction upside bias. Here's what it looks like. And again, same thing here with the momentum signature, guys, on the euro, right? For the daily chart. Since that low that we made in November of last year, break above 60, support ahead of 40. Break above 70, even stronger uptrend, support ahead of 40. And again, on this recent decline, support ahead of 40. So the momentum profile remains constructive. If we see a break below 2167 and a break below 40 on a daily close basis, that would suggest we have a downside bias to work with. If not, all things held constant, we're looking for weakness to buy in euro. Here's what the intraday chart looks like. And again, little messy as far as the intraday chart, intraday levels are concerned. This thing has been, you've gotten a lot of volatility on both sides of the market over the last couple of days. And guys, that's to be expected. You're coming to major event risk. Again, we have also a lot of geopolitical risks. We got a little bit of a good news in overnight trade with, some of the concerns with regards to the tariffs and whatnot, alleviating things. And obviously you heard about the dollar CAD or the CAD trade in general. We'll talk about that in a moment. But for the euro, yesterday we noted we had come into a support structure. So for euro, we were looking for this decline, right? Here's the update from the 15th. We were looking for a deeper pullback towards 2265 or 2240 for an exhaustion. Well, here's 2265. We actually did get that exhaustion trade last week. Okay, we rallied into the close of the week. We pulled back, that level held again into the weekly open. We got a stretch all the way up into 2355 again. This subsequent decline completes a 100% extension from the decline off the monthly high. Okay, that's 2240. That was that secondary level we were looking for on exhaustion. Here's the near-term exhaustion trade. I don't want to make any type of assertions that this is a major key low yet. I know that we were talking for exhaustion off both these levels on the 15th of last week, and both of them offered near-term trades higher. We turned right at that level for a nice rip into 2355, almost 100 pips on the upside. And then here we are again, 2240, once again ripping to the upside. These are both near-term exhaustion trades. We've gotten those. We don't want to be working with that same type of strict assumption heading into the release. Okay. Remember, there's still the possibility for that dump into 2167. In my humble opinion, again, I'd be looking for a very strong reaction there. Or if we break the objective weekly opening range highs, specifically this basic trendline resistance off the yearly highs from February, that would objectively put us back on the constructive path again, targeting 2409, the high day close, and 2460, 2450. You have a nice confluence region there as well. Actually, let me dump this 618. You don't need that anymore. Just 2460. Keep that in mind. Whoops. Didn't mean to do that. There we go. Okay, so that's sort of the game plan I'm working with. I was looking at this parallel yesterday. It's really kind of messy, but if you take it off of some of these swing lows, you offered some swing highs, a little pivot action there, you know, it continues to suggest that there's a little bit more room to downside to go. This whole region for me is absolutely critical if we break down. Okay. Again, here is one of those trades where, you know, the Monday, Tuesday stretch gave you a nice range. This break, you know, obviously we talked about this yesterday, break below the weekly opening range would shift our focus lower towards the end of the week. But support is always support. Resistance is always resistance, and those levels are paramount. So remember, just because we get an opening range break, if that opening range break takes price into a major key support or resistance, we're not going to just overlook that because it's an opening range break. So obviously the reaction that we've got warrants some respect here at 2240. And again, if we were to break down, I wouldn't necessarily want to chase this on the short, guys. More so, I'd be looking to fade that decline. Now, if we spike higher, okay, just scenarios here for today. If the dollar tumbles and you get an initial spike higher in euro, I wouldn't necessarily want to play the failure on the pullback. More so, I'd wait for the pop through, wait for the pullback to get in again. Remember, the resumption of the trade is what we'd be looking for on a pop above 24. So there's different ways that we can kind of approach this setup heading into the release. Just always remember, guys, you know, a lot of the times that initial reaction the market gives you is not going to be the market's primary play. A lot of times you'll get the knee-jerk reaction in the opposite direction that'll offer entries, actually. And that's why we talk about the fade opportunity a lot during these announcements. Questions on euro? We spent a good time on dollar and euro just to make sure we cover all the bases here. All the levels are pretty clean. No change to any of those key thresholds from yesterday's update. Okay, moving right along. Dollar CAD, my man Dollar CAD, finally. You guys know my level of frustration with this trade. There was a couple of times on this rebound. We tried to call some highs coming into key confluence regions, and the thing just continued to rip through. The weekly chart, we talked about this early in the week, was heading into a massive area of resistance. The weekly chart leaves a little bit of concern that you could see a spike higher again. That concern, in my humble opinion, is starting to be alleviated here a little bit because of the reaction that we're getting. But essentially, you know, 31.32, 618 retracement decline off last year's high. So this retracement takes into account all of 2017 trade. You have basic upper median line parallel, basic trend line resistance off the 2015 highs. I think this is 2016 high, excuse me. And current uptrend resistance. So here's slope support, a parallel extended off the highs from here, converges right in that same region, 131.32, a little bit higher, gives you the median line, but a big area of resistance, Daily chart further highlights that region like this. Okay, so here's the daily chart, and here's the daily chart that we've been following on the intraday page, 131.02. into 131.32 was the daily range that we were looking for resistance. Again, a near-term slope. This is a modified pitchfork just off of last year's low, the November high, or the October high, excuse me, and the January low that we made here. Really nice median line action, resistance, break, acceleration. There's the upper parallel right into that same confluence region yet again. Okay, momentum, really strong divergence. Well, I wouldn't say strong, but a decent divergence signal nonetheless. We were talking about this. Price action making a higher high in the closed basis, the oscillator making a lower high on a closed basis. Now, there's a couple of different triggers you can work with on this. I think I showed you this one yesterday off of these two lows. Look for that break. Okay, we haven't necessarily broken yet. This is what it looks like here now. It's only a 2-point trigger break, so I wouldn't really get too excited about it. But again, a visual graphical representation, if we do get that break below, and we do get a move below the January lows of last year, this is January's opening range low for last year's trade calendar year, that would be 29.68. And I think that would give us a little bit more conviction for the reversal trade here in dollar CAD. Okay, we've been waiting for this move. It's been 3 days coming. And here's what it looks like on the intraday charts. Here's what it looked like yesterday. The basic premise and why I was so excited, and I put this as sort of the highlight right after Euro, was because what are our favorite plays? And I say this to you guys all the time. When the weekly or monthly opening ranges are taking shape right into resistance or right into support. Why? Well, if we break a basic opening range to the upside and that upside is resistance, well, then you should really see a fueled rally. And with the same respect, if the opening range high is resistance, well, a downside break of the opening range high is that perfect conviction that you need to play the reversal. So we had the opening range for the week taking shape just below a key critical resistance range. The break below 30.46 is really what we needed to get this going. Lo and behold, we got that break. Not only did we get the break, but we also got the reversal test of resistance, former support. Here's what it looks like. Okay, there's that midnight break and overnight trade here into the open of Asia, broke lower, instantly came back, tested it as resistance. Weekly opening range lows as resistance, held, and here's the move lower. Initial targets 29.68, 28.91. I have that as our kind of near-term bullish inval, guys. I don't want you to stress the fact that it's the 100% extension of the advance per se, but basic slope. Okay, this slope series has offered some really nice pivots in price. So it all started with this is the origin, basic trendline support, 2-point touch. But then as we started to bottom out, we took a parallel, and lo and behold, again, the parallels held pretty good. Same thing on the upside. Take a parallel of that same slope off that spike high we made in February. Well, that caught the high right here. A sliding parallel of that same slope extending off of these highs, caught these highs, caught these highs, caught these highs, and converged on key resistance early in the week. Okay, so what does that mean, Mike? Well, basically the initial level right now, I'd still be looking for 29.68 on a tap there. Just lower, I'd be a little bit cautious if you're still holding shorts. Look for a reaction at this first median line. If it gives out or if there's not much of an interruption, just hold on and look for the extension lower. If you start to get hesitation, momentum starts to bottom out at 30 here, it might be a good area to take a little bit off the table, stops to break even. If you get another pullback, look for another exhaustion. But really the focus is if we can't get this last move towards support in dollar CAD. Okay, and this is the break in my mind, again, that would suggest a more significant highs in place. And a break lower, you're looking for the March open and obviously 27.60. Now, in the event that things go haywire, okay, let's say we spike lower into this region, we find really strong support and this thing rips. Once we clear 31, do not get cute with this, okay? A break above 31 in dollar CAD could be really, it could see a pretty strong run, right? So we don't want to get too aggressive on it. We need that break below 28.90 to really confirm the broader reversal. All things held constant right now, still favoring selling rallies below 31. Any questions on dollar CAD? So it's been a pretty decent look here. So that was number 3 on the session. You know, I've been waiting for this thing to turn over forever. We even got that perfect support trigger break on the turn early in the week once we cleared or once we pushed away from that resistance level. All things held constant. Again, this thing is one of my favorite setups so far. All right, let's move on. The BOE is on tap tomorrow, but we certainly want to keep our eye on what's happening with the British pound. The structure has been clean. First of all, on this session, guys, heading into the U.S. Open, just know that the CAD is the strongest performer versus the dollar. Second strongest performer is sterling. So both the trades that we were looking at from last night, sort of topping the performance charts into the open of U.S. trade. Here's what sterling, rather. Here's what sterling looked like last night. And here's what we look like now. So I don't want to even show you this because you guys have seen this a million times. This is the weekly chart. We're testing the median line as resistance on the sterling. So there's really nothing to update here. Very, very clean for the last year or so. Obviously, just a basic median line, maybe holding things up near term. Topside break, you're looking for the 200-week moving average. Okay, it's somewhere in the range of 42.80s, just below 43. Broader bullish invalidation is the Brexit high day reversal close. That's going to give you the 136.75 level. It's the only thing that would shift the broader focus lower in sterling. Daily chart for pound looks like this. We're holding this. This is the intraday chart. Here's the daily pattern. Again, there's the median line. There's the high day close for this year. It's 41.34. And that would be the break that would fuel the larger ascent here in sterling dollar. Okay, near-term support, you got that swing low from last week, converges on a pair of parallels. So, basically looking somewhere in the range of 38.50, 38.60 for near-term support, bullish invalidation 36.70, 37.65, no change to that. Intraday, sterling looks like this. Still liking the broader upside of the trade. Nothing's changed there. Here's what the intraday chart looked like last night. We were talking about near-term support at 39.79. Our bullish invalidation for the near term is still 139.13. Okay, this is 618 extension, but it's also that pivot that we made in price, very, very objective, as well as the lower median line parallel. So even if price collapses this low, objectively, this is also the weekly opening range low. So I love these setups, guys. When you have major confluence resistance or support that coincide with basic opening range strategies. Again, these are your conviction setups, right? So still looking higher above 39.16. A topside break, the levels are pretty clear. 41 is 618 retracement, but this is a big region of confluence resistance up here at 41.36. It's also the high day close for the year. And that's the break that would really fuel, I think, the next move higher in sterling. So, game plan for sterling, just to put things on paper here, is buying pullbacks above 39.16. Need that break above 41.30 to get the sort of extended play higher. But it's been pretty clean. It's been pretty clean. Again, even here in sterling, guys, you have a very clean weekly opening range. This is your weekly opening range low. Here's your weekly opening range high. It's Wednesday. We're still trading in the confines of that range. The break should offer guidance here in sterling. Questions on the British pound? Like I said, the BOE is on tap tomorrow. That will probably hit the wires, obviously, before the webinar here. So just keep in mind these key levels that we're looking for. Constructive above 39, really 41.30 break is what we need to get the resumption of the broader uptrend. This thing is pretty strong here. You also have that weekly momentum trigger. Keep an eye on that into the weekly close. Daily, don't think you have anything momentum-wise to work with. We could work with this. Just to put some color on that, okay? And note that we turned right ahead of 40. Same thing. These momentum profiles, guys, can be so helpful in just helping you ascertain broader directional bias. Ever since the low that we made. And you remember here last year, I was catching all that heat. We were all catching all that heat across Twitter and all different mediums of being constructive sterling. It had come into a free fall from the Brexit gap. And we spent nearly a month testing that lower parallel. We kept on looking at this weekly profile saying, look, momentum is holding above 40, plain and simple. We can't get bearish, right? And obviously, lo and behold, since then, we've continued to hold 40, multiple breaks into overbought condition. This is still a constructive momentum profile. What would change that opinion is if we rally here and fail at 60, and momentum or price fails ahead of the high day close, that would be something to be concerned about, that we're going into a little bit more of a range / downward sort of trajectory in price. But certainly trading still between critical levels here. Okay, so that is sterling. Next up on tap is Aussie. A little disappointing with the Aussie because we just haven't gotten, like anything conviction to play with. So here's what Aussie looked like last night. We've been tracking this one obviously for the last couple of days as well. We opened the week saying that this thing was coming into major support. It was the yearly lows. It was the monthly opening range lows. And certainly we said this is make or break here. Last week we did close below it. So the risk heading into this week, which we noted, was for price to continue to move lower. Okay. Ultimately, if we get a drop near 76.36 or specifically 76, both of these would be levels I'd start to look for a little bit more of a stronger rebound in price. Remember where we are on the broader scale. For Aussie, for me, look, there's nothing to do until we recover above 77.50 or we drop into 76.30. Those are my two plays for Aussie. Everything in the middle, in my humble opinion, is going to be chop, guys. It's going to lack conviction. So the ideal scenario for Aussie is to get that last dump washout towards 76.30. 618 retracement from the advance off just last year's May lows. Obviously, the 38.2 retracement from the advance off the broader 2016 lows. Both of those converge on a 3-point touch support right here, and former resistance, also a 3-point touch. Pivot on both sides. That converges all right here. So from a weekly standpoint, 76.36 on an intra-week spike wouldn't change anything for the broader uptrend that we've been trading in for the last 3 years. So in the meantime, I don't really have a conviction set up here on Aussie. Like I said, we had an outside weekly reversal last week off the monthly open. That is bearish. The break below the monthly opening range is bearish. A drop into 76.35, 76.30, cool. I'll be looking for possible exhaustion. A breach back above 77.50, well, that might suggest that we're putting in sort of a lowered floor and exhaustion low before rebounding higher. So the weekly chart has us, not near resistance, not near support, right slap in the middle of a larger range that we're watching. So just keep this in mind heading into the weekly close. This is what's going to be paramount. Again, here, I can't drill this home hard enough. Momentum signature since the lows that we made in 2016, late 2016, has continued to hold 40 as support. There's 40. Okay, a little dribble there late last year. But until that gives out, until that basic objective momentum profile changes, we're still working with the assumption that this could be a broader correction within the uptrend. So 76.30, write it down, put a sticky note on your screen, whatever you got to do, set an alert. That's the big level for Aussie. Now, looking at this on the daily chart, those levels continue to reflect. You got the 618 retracement right there, that same one, 76.36. I wrote yesterday that even if it spikes into 76.11, I wouldn't necessarily change any of my broader opinion. Okay, a weekly close basis, yes, I need to see it close above 76.30. But intraday, that would complete a 100% correction off the highs. And that would be a deeper touch of the basic trend line support off the 2016 lows that we've been talking about, right? So basically into the close of the month, early next week, could be when we drop into that key zone. That being said, a break above 77.50, 77.43 right here, same thing. You got your weekly open. It's the opening range lows for the month. That big pivot that we've been watching since the start of the year. Break above that would certainly suggest that a larger rebound is underway. Maybe a more important low has been registered. Okay, here's what it looks like on the intraday charts. So I even noted this last night. I'm not typically a big fan of these really sharp down slopes. I've just, over the years, I've seen this happen and time again. You don't really get the conviction breakout. And I think this is a primary example. If this was a conviction breakout of a near-term channel, I would have wanted to see a run. Now, the fact that we posted an outside 2-hour reversal candle right after breaking higher and we're testing that as support has the emphasis on this right now. If this low holds into the US Open, we push higher, could be a basic trend line resistance break, check as support, and move higher. I happen to think you possibly could see this thing still break down towards 76.30, that key region of support that we're looking at. Okay, and down here, we'd start to look for exhaustion on one of these two levels. Any questions on Aussie yen? Or Aussie dollar, rather. We'll take a look at Aussie yen later. No changes to any levels that we've been following here on this pair. A spike into 76.30 would offer opportunity, in my opinion, and break above 77.50 would shift the focus higher. And remember, a 77.50 break would be an objective break of the weekly opening range highs. Again, objectively, that would give us a price action directional bias towards the highs heading into the end of the week. All right. Last but not least from yesterday, Euro Aussie number 6. This is one that we've been tracking also for the last couple of weeks, I would say. The basic focus of this trade heading into the start of the week was, look, we're coming into a key resistance range on all three timeframes for Euro Aussie. That level was defined by a couple of different critical ranges. So here's Euro Aussie as it stands right now. I guess I'll show you really quickly the weekly chart. So Euro Oz was coming into this big resistance region, 160.18, 100% extension from the advance off of last year's low. Okay, so boom, boom, boom. You also have a median line here, longer term. So this is really the weekly close is what matters with these median lines here. But right off the bat, you got divergence in momentum. We got a trigger break, and it's been resistance ever since. So you're seeing a little bit of a waning momentum signature. Daily chart. Well, that had us coming into resistance as well. Same level, 786 retracement, 100% extension. Just higher is 160.76. And this is why I was telling you guys last night, it still would be surprised if you got one last breach higher. Also looks like this could be a 1, 2, 3. So you get the pullback 4. If that was really short-lived, the 5 would give you maybe 60.76 as a topside stretch to achieve both of those levels. This is a former swing high from early 2016. But more importantly, just the basic upper parallel, which caught the high here, that converges there, and current slope or channel resistance, a parallel off these two lows, extended to the high that we made last month, caught the highs this month, and again, that same slope converges on that 60.76 level. So the whole premise since the start of the week is to look for an exhaustion high to fade. Now, there was an opportunity early in the week because we opened right at that confluence region. And on the Sunday or Monday update, we were talking about look for one more high to fade. We got that one more high. It was a beautiful fade. Last night was kind of annoying. We turned right ahead of the channel support or the lower parallel. So I was looking for a drop into the weekly opening range lows that converged right there. Super clean confluence. Obviously, markets had something different in mind. So we turned here just ahead. We have a very well-defined weekly opening range. If this slope is legit, we should look for median line resistance. And again, that takes you into 60.17 again. Obviously, 60.76, that level we just talked about on an intraday spike. This should be somewhat contained from the Fed. Obviously, the dollar is not involved here, but, fluctuations versus the dollar on its own merits could push this thing around. But largely speaking, this should be somewhat insulated from today's Fed event. So objectively, I'm looking for failure here in an ideal scenario. If we break higher, that could achieve that one last 1, 2, 3, right? Pull back on the 4, and the 4 is in 3 waves. It gives us one look for 1, 2, 3, maybe a pullback here, and then a last 5 wave before it starts to move off again. So based on the wave count and where we are in price, wouldn't be too surprised if we surpass this high to achieve that 60.70 target. Ideal scenario, basically off that turn. If we find resistance here, you're basically looking for a break of the lower parallel to give us the conviction reversal in price. Okay. Guys, does that make sense? Another one where the Elliott wave sort of near-term pattern does suggest that we should be looking for one last high before turning over. There's a beautiful play on the reversal here, but that fizzled out ahead of support. So the call here is done. Now we have to reassess the scenario. And again, still looking, same two levels that we came into the week looking. 60.17 or 60.76 for possible reentry back on the short side. Obviously, guys, if we break above 60.76, forget about it. There's really nothing on tap until 62.50s. You have a lot of room on the upside if this breaks. All things held constant, you're still coming up into uptrend resistance. Questions on Euro Aussie? Okay. I do want to take a moment just to really quick talk about Aussie yen. We talked about where the Aussie is and kind of like, lackluster. I still, if you put a gun to my head, I'd still think he'd look lower here before finally turning higher. Aussie yen's been doing the same thing. So, where is it? Here's Aussie yen. So, on the longer term prospect, on the medium term prospect, same similar scenario in that it came into a big support. The yearly lows from last year, we've talked about this pivot for the last couple of days, so I don't want to waste your time again. But if we break below this, there's a big room for a large decline towards 79.40. Until this breaks here, you're getting some divergence in momentum. I don't want to really test it. I don't really want to test it. Remember, Aussie broke its lows for the year. Aussie yen has not. So a lot of times when you see that divergence, let me take that back. Aussie yen has broke its lows for the year. I stand corrected, but it has continued to hold those lows from last year. So those divergences, when one makes a new high or one makes a new low, something to pay attention to. On the daily chart, okay, the 2017 low day close, we still haven't gotten a daily close below that, 81.59. So if there's going to be an Aussie exhaustion trade, I feel like Aussie yen might be the one, guys. Aussie yen might be the one more so than Aussie dollar. But we'll have to see how today settles out. So I'm flat here. I don't have any positioning on this. I wish I did, but I just didn't have enough conviction. The play that we had in hand at the start of the week, we were talking about confluence support right here at the low day close. The failure here did see a perfect rebound into resistance. Okay, I haven't changed any of these circles from the Sunday update. So we probed through that 2017 low day close, but we finished the day above. We never closed below it. And here's the rally higher. Here we are testing that low day close again. Long story short, guys, here, there's no point in really trying to force a trade on this one. I'm going to trade this as a basic objective weekly opening range. You're right slap in the middle of the weekly opening range, so there's no favorable positioning from these levels. But we'll have to see how this moves higher. The momentum signature hasn't fixed itself, so this is still as bearish as it gets. From the high that we made, you broke well deep into oversold, and then on the rally, you turned well ahead of 60. 54 was the high, and we're turning lower again. So the momentum profile still remains bearish. And again, from an Elliott wave standpoint, you're getting that same type of count. Here's the 1, 2, 3. This could be a 4. You look at that last extended wave 5 to complete the series, especially because on the way up here, while this did look like the 5 initial advance that we were looking at last week, the broader count still looks like a 3 up. So it's kind of messy. But for Aussie yen, you're slap in the middle of the weekly range. Look for a break of that weekly opening range for conviction. Big support on the downside move would be 80.50. And also just keep in mind, guys, the basic structure that we're in. I mean, I know that the Aussie yen in the larger term still looks kind of messy. This pitchfork has continued still to be, rather clean. You zoom it out into the 240 to give you a better look, right? Pretty decent on the median line resistance, median line resistance, median line resistance, resistance, break accelerated to the upper parallel. A sliding parallel caught the highs exactly. Downside break below the median line again accelerated, median line resistance. Well, the lower parallel is down here if this is going to continue to hold this formation. Okay. Okay, so those are the setups I'll be following today, guys. It's going to be it's going to be interesting to see how this pans out. Again, it's not about the rate decision, whether we get the hike or not. That's priced in. It's all about the accompanying projections and the commentary from Jerome Powell. So let me jump into your questions at this point. If you have any other questions or trade setups you want to review, I know that Pooja is looking at CAD yen. We missed that yesterday. Let me take a look and see what that's doing on this yen move, on this CAD move rather. Huh, look at that. We rebounded right off last year's low. Perfect rebound. Okay, let's clean this up a little bit, shall we? And obviously on the daily charts, guys, these pink lines represent yearly opens. So I'm just kind of scoping out what we've been doing. 2016 was essentially a wash. I think I tried this before. There's no slope that really offers too much clarity on this. Obviously, you want to note the strong divergence into the lows here. Now, these divergence signals are both below 30, so I wouldn't call it a strong signal per se, but certainly the region which it covers is pretty big, right? Price action made a much steeper low as the oscillator made a much steeper high. So something to pay attention to. Nice base. CAD strength is what we're looking for on dollar CAD lower, Puja, right? So I actually would be in favor of seeing a larger recovery here in CAD yen. Obviously, I just deleted it, but there was a trigger that just gave out on that break, right? Decent break there. That's your divergence signal on the low. Moving higher. Let's see what the daily looks like. Or the intraday, rather. Well, let me just see what the 236. Do we rebound off that? No, we rode through it. It's fine. Okay, look, it's too early to work with this slope, but I'm just going to highlight it because I do want to see if I can get some color to this. Look at that, Puja. I'd be working with something like that to see if we get any kind of play off the median lines. And let me just do this. Bear with me one sec. Sorry, guys. I want to clear this out. Null and void. Oh, that was the low. Sorry, keep that. Actually, no, you don't need that. Okay, it's the 2017 low. Let me see if I have a weekly chart on this. Okay, so this is actually a little bit better of a weekly divergence signal. Puja, really, really subtle. But like I always tell you, these subtle ones sometimes are the best ones. So price action obviously making a series of lower lows, the oscillator making a slightly higher low, but that both of those reference points within the region, right? So pretty big. Yeah, I would be with you, Pooja. She says looking for a long position. I'd be with you and looking for a long entry. If this, again, it's too early. I hate to throw out slopes, guys, that don't have conviction on it, but it's too early to work with this. But this, if this slope is correct, you'd be looking for a support on a pullback somewhere near the lower parallel. And I don't think if this is the reversal, I think it could be. I don't necessarily think you'll get all the way down there. So if this stretch comes into resistance, the better play, Puja, would be to look for a pullback to the 50 line for entry. You can't do anything from here at this level. If you go long, you're just chasing. So that's how I would look to play this. Let me see what it looks like on the closer time frames. So this is a retracement essentially of the monthly range, okay? It's not quite the monthly high. This would be the monthly high. Near term upside objectives. What is the low day close? That would be perfect. Yeah. So this is how I would play. A lot of times when you get these reversals, they're very tricky. Obviously, you know this, Pooja. I don't have to tell you. But you know, on initial touch for the pullback, 81.11. Okay, the low day close for the year. That should offer some support on a pullback, Pooja, if we are turning higher. Now, the divergence signal that we're looking at, obviously momentum on the intraday has made it above 60, so it kind of dispels that near-term immediate downside momentum bias. So yeah, I mean, even if you get a pullback near 81.12, 81.11, I'd be looking for a support hold there. Ultimately, 82.46 would be an upside play. The highs for the month, basically converge. Let me just bring up the 100% extension then, or the 100 full retracement. That gives you 83.65, 83.74 as your critical resistance. And a breach above that would be an objective monthly opening range break. It would put you back within the confines of that formation. It would certainly shift the focus for a larger rally in CAD yen. Really nimble on these, right, Pooja? We're just getting the sort of initial turn in price on the pullback, the first test of the week of the yearly low day close. That, in my mind, a defense there would be all the conviction I would need to continue favoring alongside here in CAD yen. Pooja, does that help? Does that offer some color there? Interesting pair, but with what the CAD is doing, I'm liking it. I'm liking it with what dollar CAD is doing. She says, yes, thanks. Okay, you're more than welcome. Iman says, hi, Michael. Can we have a quick update for our beloved pair, the dollar yen? Dollar yen, I'm short trade at 106.48. So I was thinking, Iman, about dollar yen all last night. I typically do put a yen chart for all U.S. economic announcements. So whether it's NFPs, CPI, FOMC, you see me always typically put a dollar yen chart for you guys. I'm that confused right now with dollar yen, man. I don't want to touch it. Look, let me take a step back. The broader picture for dollar yen actually is clean. Let me correct that. The problem with it is that the near-term prospects are not. Okay, so here's dollar yen on the weekly chart. We've been tracking this chart week in, week out for the last couple of months. 107.80 into 108, key resistance. 105.19, key support. We've been talking about that. You got the slope line in there too for the current gradient that we've been working with off the highs from 2015. So all things held constant, guys, this is still in a range, period, exclamation point, end of paragraph. So for me to try to get a position on FOMC, it needs to break the range. Now, near term, there is a consolidation range I'll show you in a moment. But how to play that on an FOMC, look, guys, there's not enough conviction here for me to do anything. Momentum has dropped below 40, but has since leveled off. Technically, there is a little bit of divergence on these lows as price action continued to hold that low in the oscillator. But, the weekly chart just gives us a big, big range, 105.20 to 108. That's like a 300 pip range almost. So what do you do with that? Fade a move into the 2017 low week close. Yeah, if you get up there, Digon, that might be a play. Look, let me take a step back. If we were to get up there, Digon, I'd be looking for a reaction. Ideally, it breaks down and we get that drop into 103.40. That's sort of like if things are in an ideal world and Michael is getting his fairy tale wish come true, I want to see dollar yen rip higher into this region, fail miserably, and then move lower with a break below 105.20, finally getting us that 103.40, 103 target. This is a level we've been watching for a while, guys, right? Ever since the high that we made in November of last year, right here. The measured move of that extension gives you a 100% extension here. That's basic slope that we've been following. Let me zoom this out, Dagon. You're newer here. I just want to make sure you get the broader picture of what we've been watching in dollar yen. Here's the broader, weekly chart looks like. We've been working with this formation here, perfect touch, nice pivot, resistance. That same slope has defined so many turns in price, right? And that same slope converges right there with the 786 retracement of last year's advance, or this is the 2016 advance, excuse me, and also the 100% extension from that same yearly decline. So, that would be the ideal scenario. Dagon, does that make sense? If you were to get a spike into 108, I wouldn't just blindly sell there. I would need to see some sort of reaction in unit price, but that would be the ideal scenario. Yeah, 300 pips is a long way up, says Dagon. I agree with you, man. Iman says, yes, I'm playing the range targeting 106.05. Okay, so you're close. Dagon says, got it. Thanks, Aaron. More than welcome, Dagon. So I'm going to get closer. I just wanted to show you this on the weekly chart. Daily chart looks like this. The weekly opening range is perfect, remains intact. Here's your resistance on the monthly opening range. We slammed into the lows, May low, okay, from over here. Okay, look at that low has been a pivot on every single approach. The breaks have been accelerated. Support, obviously, earlier this year, back in February. Again, we failed to move into that on the monthly opening range. We tested the monthly opening range last week, held perfectly, and here we are still within the confines of that range, sitting slap in the middle of the range. So it's one of those low conviction trades, guys. Remember, you always want to position yourself where you're near a resistance or near a support target to trade against. For me to jump in here mid-range for the month, I have no clue. But what I do like, and here's a trigger, guys. This is where you know that we're on a larger recovery. If we break higher and price maxes through 107.45, forget it. All things held constant, you actually also do have a support trigger to watch here. Okay, on a downside break. Now, the intraday chart, I guess this is the only thing that matters today, right? I'm going to do something here to clean this up. We've been watching this nice median line formation. Like, again, the median line has been textbook support, break, resistance, break, resistance, resistance. We're doing nothing around it right now. So I'm going to get rid of this for a moment to highlight this key consolidation. And I was going to put this yesterday on the report, but I just, for me, I don't do anything till this breaks. So it highlights resistance here at 106.90 near term, highlights support here at 105.68, 105.55 near term. If you feel compelled to play these levels, sure. If we rip into this region and we get exhaustion here, might be worth taking a short against that level or even against that high from last week, looking to play the move down. If this price tumbles today and it fails at the weekly opening range, well, guys, that's objective, right? If it fails there, it's worth taking a shot. Stop against last Friday's low, looking to play the recovery. I just don't have anything here that's a conviction, guys, until we really start to get into the nitty gritty and either get closer to 106.90 or closer to the 105.80 level. Until that happens, it's a wanderer. Guys, does that help? Iman, does that make any sense here on dollar yen? I know that you're still you're targeting 106.05. So look, what's at 106.05? Are you looking at something specific? Make sure that we're targeting a specified level here. Okay, so keep these two levels in mind right here. Forget everything else. Okay, 106.10, just a range trade. She's saying, okay, still, even if it's just a range trade, amen, I don't mean to pick on you at all. I'm just trying to help. Don't just target a random level. Everything we do needs to be based on some sort of technical metric. So I don't necessarily have anything at 106.05, but I do have something at 106, 105.98, and at 106.10, which is what we've tested yesterday on the rebound. And right now we just tested it and rebounded again. Watch for a break of that 50% retracement. If you do get that, just leave your limit at 106. It's going to be a 618 retracement. Nice play. But just know that 50% does exist, and you're actually you are seeing some sort of near-term pivots off that region. Okay, so actually in time, that comes into Asia trade here, if that's going to pan out. Just want to see if that gradient has given us anything. Not much. but it does continue to highlight that same topside target if we do get the breach. Okay. So just hope that helps. Amen. Cheers on that. All right, guys, I'm way over on time. I've been flying over the time these last couple of webinars. We'll wrap it up here. Thanks for everyone who attended. Don't forget, Jamie's on tap in just under an hour and a half for the midweek strategy webinar. You know, he typically does it on Thursdays when we have the FOMC, but he wanted to do it earlier this time to kind of give you guys a nice secondary preview right before the release. So 11 o'clock Eastern, don't forget to see him then. And I will see you guys tomorrow morning to cover the aftermath of what promises to be a very interesting release today, guys. Trade light, keep your size and trade magnitude a little bit lighter as we clear out this event risk. And again, we'll cover everything tomorrow. Check the aftermath of what price action is doing as we head into the close of the week. Till then, best of luck trading, guys, and I will see you tomorrow morning. Cheers.